negative tone where it's like 2025 was a pretty bad year I think you said called it a disappointing year for Bitcoin. It's a function of how it works. But I don't think it's reflective of the operating company because they haven't really been up and operating yet. So the fixed income market is the largest market in the world. Right now, the bond market has built the fixed income market on a dollar standard.
Why does the market pay more for the company than the Bitcoin it holds? Why trade at a multiple higher than 1.0x NAV, net asset value? Moses points to the mining and banking analogies. A gold mining company like Newmont doesn't trade at 1x the value of the gold in the ground. It trades at 2x or 3x price to book. Why? Because they have operational excellence. They have management. They have credit facilities, and they have the ability to apply leverage. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
It seemed like I ran it through AI to figure it out, and it seemed like the crux of the matter, the argument back and forth with you guys was, if a company drops below 1 times MNAV, how does it recover?
It was kind of so I think
you were trying to get him to answer that and he wouldn't answer. I think Bitcoiners, they take a Bitcoin view into the treasury companies and without realizing that your sound money thesis and anti-fiat and Jeff Booth don't feed the system and perpetuate it and all that, that is ideology, and that's correct. And as a Bitcoin maxi, that's the view I have. But that's not the world that we live in today. Mm-hmm. So what percentage of people would you say have taken a 5% allocation to Bitcoin?
What percentage of people?
Yeah, 1%?
Tiny, yeah.
Less than 1%?
Less than 1%,
right.
Maybe.
And so that would be hardcore. Like they'd take a 5%. But even those people would have a 95% allocation to other things besides Bitcoin. So when you start asking like, why would I buy a treasury company and not Bitcoin? As a Bitcoiner, that's what we ask because Bitcoin is our hurdle rate. But 99.9% of the world doesn't ask that question. Mm-hmm. They're trying to beat CPI inflation, or they're trying to beat the S&P 500.
Yeah.
So they buy a basket of stuff, right? So right off the bat, a Bitcoin treasury stock is not competing against Bitcoin. And Saylor told me in Prague, we had dinner, he's like, I've never targeted Bitcoiners. He's like, I've never brought a Bitcoiner in. It's not a replacement for Bitcoiners. It's not a replacement for Bitcoin and cold storage. So the question that is most commonly asked in the Bitcoin space is, why should I buy a treasury company, not Bitcoin? And the answer is you shouldn't. Mm-hmm. The answer is you shouldn't. But they're not competing for Bitcoiners. Even the hardcore 1%ers still have 95% allocated to other stuff.
Yeah.
So most people are not asking, will it be Bitcoin, number one. Number two, I think this is just an a priori truth. If you buy a Bitcoin and I buy a Bitcoin and Bitcoin 10Xs, who makes more money? Same. If I borrow 30% LTV against my Bitcoin and buy more Bitcoin and you don't, and it goes up 10X, who makes more money?
You.
Why?
Because you've leveraged it.
Leverage, right? So that's just basic math, right? Mm-hmm. So why would a Bitcoin treasury company trade for more than 1 times? Because they're applying operational excellence, management, and leverage, right? So when you have like a fund, a closed fund, right? And there's, by the way, why would there be more than 1 treasury company? There's 1,000 closed funds in the US alone.
Yep.
Why is there 1,000? Why isn't there just 1 fund, right? There's 1,000. Each one has a different risk return profile, right? So with a closed-end fund, a lot of times they'll trade a 1-time, sometimes a discount, sometimes a positive, right? A multiple, positive multiple. Why? Because there's a market and people trade it. But when you look at what like a treasury company is more analog to, would be a bank, right? So a bank takes customer deposits, they pay a yield on the deposits, and they invest the money and they make the arbitrage. It's also very comparable to a like gold mining company, a silver mining company. So I'm asset heavy, right? So I have the gold in the ground, but I don't trade at 1 times my gold value, my book value, because I'm an operating company. And so I'm gonna get a multiple on top of my asset. So the banks are gonna trade at 2 to 3 times book value, price to book. An operating company like an oil company or a gold company would trade 2 to 3 times that, because it's not just the gold in the ground, it's also the potential future value of the gold.
Yep.
Right? Oil is a little bit different because oil is so volatile, but like gold companies are priced a little bit different. So if you look at a Barrick Gold or a Newmont Gold, for example, you'll see them like a 2 or 3 times book value, because the gold will be worth more in the future. Plus they have the operating leverage. They can use credit, equity, they can expand, they can do all types of things. So when you look at a treasury company, you go, well, they're more like that. They have an asset like gold. I believe Bitcoin's better than gold. So do you. I believe it's more explosive. So just right off the bat, they should have an increased premium than a gold company because their asset is better than oil or gold, in my opinion. Then we have the operating efficiency. Now, some treasury companies have terrible management and they should be discounted.
Yep.
Some are really good and they should get a benefit. So then the operating company itself, the management, et cetera, is going to get a premium or a discount based off of that. Okay, so that's why it would trade more than one times. This type of a company should never trade one times. It's not a fund like a ETF, right? They apply no leverage, right? It's just there's arbitrage against it, which is why the price fluctuates. But really, it's negative. Really, it should trade at a discount to NAV because they're charging fees every month. From a Bitcoiner lens, it doesn't really make sense. So we have to sort of get rid of that and think about it from a traditional financial market lens. What Bitcoin Treasury companies are doing is they're soaking up the demand for yield. Think about that for a second. The demand for yield, that's the fixed income market. The fixed income market dwarfs the equity market, dwarfs the commodity market. The fixed income market is the biggest market in the world. Why? Because there's always a demand for yield. Some people have assets that they want yield on, and some people need to borrow. Google will drop a bond because they need to build a new data center. So there's always a borrower, and there's always somebody that wants the yield.
Yep.
That's never going to change. Bitcoin is not going to change that. Like, that doesn't change the way humans work. We have consumers and creators. Creators create more than they consume. They have savings and they're going to loan that savings out for yield. That's the way, whether it's Bitcoin, gold, or fiat, that's how it works. So the fixed income market is the largest market in the world. Right now, the bond market has built the fixed income market on a dollar standard. What can happen now is we can build the fixed income market on a Bitcoin standard. So there's an insatiable, unquenchable desire for yield. And so we need to build the yield products. Now, to your point about MicroStrategy, why would there be more than one? Like, MicroStrategy's got a cover. They got 4 prefs out there. Like, that's all we need. Then why do we have 10,000 bonds in the United States? Every bond is different. Every bond is a different risk and reward profile. Every bond is a different company. Every bond is a different term. Every bond is a different yield. There's 10,000, not one. Even just US Treasuries alone, there's whatever, 10 or 15 of them, right? From months to 30 years, right? So there's 10,000 bonds. Why is there not just one bond? So what you're saying is Stretch is such a good preferred. Why would anybody else, like, they're so secure, they're so stable, they have such a good track record. Why would you buy anybody else's preferred? Is what you're asking, right? A preferred is an equity. Yep. Most of the world can only buy commodities, or can buy bonds. They can't buy equities. A preferred is a stock, it's an equity. But most of these fixed income funds can only buy bonds. MicroStrategy doesn't have bonds, nor is he gonna create bonds.
We have to talk about the haters. Many small-cap Bitcoin treasuries have seen their stocks drop 90%. Is this a failure of the model? Moses explains the mechanics of the public market. Many of these firms enter the market through a reverse takeover, RTO. They raise private money at, say, 1 penny. Speculators see the Bitcoin Treasury news and drive the price to 10 pennies before the company is even approved to operate.
I think what we're talking about is treasury companies competing for the yield market, not necessarily the preferred market.
Okay. So you think basically they're just going to come out with new products?
There's 10,000 products that can come out. Now, why would I buy a bond from Apple instead of a bond from Google? Why would I buy a bond from LA County versus LA County? Why would I buy a bond from LA County versus LA Department of Water?
Different risk profile. But why didn't he just say this to me?
because he's here. So that's why I want to give you like a layman's view of this. So think about insurance, Danny. Like, how many types of insurance are there?
Who knows?
Just types.
Health,
house, home, whole life, term life, travel, disability. There's hundreds of types. Why isn't there just one type of insurance? Why does there have to be hundreds? Okay, of the hundreds of types of insurance, how many insurance companies?
Thousands, tens of thousands.
Tens of thousands. Why isn't there just one insurance company? Why do I need more than one insurance company? That doesn't make any sense. Why not just one insurance? The AIM is the biggest insurance company. They've been around for 100 years. They have the best policies. Why is there room for any other insurance provider in the marketplace? So a couple things. So obviously, number one, the volatility of the nature of the company, which is a multiple of the volatility of Bitcoin. So I had dinner with Michael Saylor when I was in Prague last year, and he gave us this story, and he said, imagine that God came to me in the middle of the night, and God told me that the market was going to crash tomorrow. So I woke up in the morning and I went and hedged MicroStrategy, and sure enough, the markets crashed, but MicroStrategy didn't. That'd be great, right? The shareholders would be stoked, right? No, because they expect MSTR to trade 2 times volatile to Bitcoin. So if Bitcoin goes up 5x, MSTR should go up 10x. But if Bitcoin goes down, we should also go down 2x. How far did Bitcoin drop? 30, 35%? What's MicroStrategy down? 60%. Exactly 2 times. Exactly what the market is expecting it to do, a 2 times volatility. Now, some of these are 80, 90% down, whatever. So like we could look at Nakamoto, for example, right? So if you look at like Nakamoto, the company I'm working with, Satsuma in London, we're also sort of the same victim, but you have to kind of like peel back and look at the nuance of that, right? So again, if we just look at like traditional market finance, the way, let's just use Uber as an example, first of all, right? So Uber started as raising money from friends and family, and then angel rounds, and then VC rounds, and eventually they do a pre-IPO, right? Which is the last investors come in privately before it goes public. So now after 6, 7, 8 years, it finally goes public. What happens? All the insiders sell because they bought it and they were hoping for liquidity, and the pre-IPO investors got in because they wanted to sell as soon as it went public. And it's not necessarily like mean or malicious, but they dump on retail. Not because they're mean or malicious trying to rug pull retail. It's just like they've been waiting for 6, 7 years for liquidity. They finally got it, right? So what happens is naturally, as soon as we hit the public market, all those insiders dump. And then unfortunately, retail bought it and whatever. Okay, well, a lot of these treasury companies did something similar where they took an already existing trading company, like a public company, and then they did an RTO, like a reverse takeover. And then they raised a pipe to raise the money. Okay, so what happens is, and I can tell you firsthand, because through my fund, Bitcoin Opportunity Fund, we've invested in dozens of these, and I've helped launch a couple now. So like what happens is, like with Satsuma, for example, we announced, because it's already a publicly trading company that you could already buy the stock, we're required by law to make a press release that we're going to raise money. So a press release went out in July and said, we're going to raise our goal is to raise $100 million into this company at the price of 1 pence. And that was the public price at that day. So today it's 1 pence. We're going to raise 100 million at 1 pence. And we put the press release out. As soon as we put the press release out, the speculators started driving the price up. And what we did as a company is we were like, no PR. It was a policy. David Bailey, he didn't really follow that. And so like there's nuances to all this, but this generally applies to asset like Strive's company or Mahler's company or Nakamoto or Satsuma. David Bailey did talk it up quite a bit, so that was a problem. What we tried to do is not talk it up at all, but we had to put the press release out. So we tried to like let it go quiet, but they drove the price up 10x. They drove from 1 pence to 10, right? And then we're still raising money. So that went on for a couple months. Then the haters come out. How dare you raise money for the insiders at 1 when the public price is 10? It's like,
that's just the market. There's not a lot you can do about that.
Then we got delayed, and then it finally just got approved right before New Year's, and now the price is down 90%. But 90% from what? The company wasn't even an operating company. We just got approved 2 weeks ago. So all that price action in the stock isn't really reflective of what we're doing. And so same with Nakamoto, right? So Nakamoto did this. Now, again, David Bailey was very loud about what he was doing and how much money he was raising. And so that's a whole nother topic that's above my pay grade. And, you know, when Elon Musk tweeted about Tesla stock, he got in trouble. And so maybe there's some wrongdoing there. I'm not alleging there is, but my point is it drove much more attention. Bitcoin Magazine, Bitcoin Inc., obviously, right? And so the speculators really drove that price up big time. They got delayed. And then same thing, it dropped 90%. And so it's just a function of what happens when you take a private raise and you go public. It's amplified in that type of a market because you already have a publicly traded company. And so then the speculators start driving the price up. And so it's a function of how it works. But I don't think it's reflective of the operating company because they haven't really been up and operating yet. We understand as Bitcoiners that Bitcoin is a system of rules, not rulers. So unlike crypto, Ethereum, et cetera, those run on proof of stake, which means that the more tokens I have, the more tokens I stake, the more votes I get on the protocol and the consensus, right? So then people who have more tokens get to basically run the network and change the rules as they see fit, sort of like our fiat system we have today. But Bitcoin doesn't do that, right? So I could own more Bitcoin, but I get no more votes in the system. So as far as like how much Bitcoin, is it good or proper? I mean, that's for the free market to decide. What is safe? I mean, we've seen where, like in 2008, the banks were too big to fail. So we've seen, potentially where maybe one institution gets so big that if something happens, it could destabilize the market temporarily. Yep. So we could argue like a safety thing. I don't think it's a control issue.
No,
so
I agree with that.
I don't see a problem on the control issue. We could argue like a safety thing, but like if MicroStrategy got in trouble and dumped 650,000 Bitcoin into the market today, the market would barely shrug.
Do you think?
We saw 900,000 Bitcoin get dumped twice this year. Well, in 2025, right? Wasn't that like $9 billion?
So there was the big like whale that sold through Galaxy. I think that was 80,000 coins.
Oh, sorry. Yeah, sorry. 80,000. Yeah, not 600. That's a big difference because that's like 40 billion, I think is what he has. 50 billion.
Yeah, I think it's about 50 billion.
About 50 billion. So it's a big difference from 9 billion. You're right.
Yeah.
But obviously anybody would know, like nobody would dump 50 billion in a day.
Yeah.
Because if I want to sell 50 billion, I don't want to have the slippage. Mm-hmm. So I'm going to, of course, roll that out. So even if something were to happen, hypothetically, which I don't see this, so I'm certainly not saying this is the case, Michael Saylor has built like an impenetrable fortress. So there really is no forced liquidation there. But even if, went through bankruptcy, changed hands, they wanted to liquidate the stock, unwind the company, they're not going to dump 50 billion in a day. So I just don't see a lot of risk there. But what I would say, again, sort of drawing parallels to other markets, when you look at the gold market, how concentrated is the gold market? How concentrated is the equity market? 3 companies own like 85% of all the stock. Mm-hmm. Vanguard, State Street, and BlackRock own like 85%. So when you talk about 3% position by one company, it seems like inconsequential. And again, Saylor's only doing equities. There's a whole market of bonds. The other thing is that, again, trying to understand the financial market, most of the financial market and things we can talk about that was in my outline is matching liquidity, risk, and duration. So most of the liabilities, so assets and liabilities are tried to be matched over duration. So like when the banks collapsed in 2023, they had a mismatch in duration. So they had 30-year debt, but they had cash that was due now, right? So most of the debt is typically over 5, 10, like your auto loan, your house loan, right? It's termed. Saylor's doing perpetual. Market doesn't really know what to do with perpetual. Mm-hmm. So when I sat down with him, he's like, hey, you could have $100 billion business just with 30-year bonds alone. You should do that. I'm not. You could have $100 billion business with 10-year bonds. I'm not going to do it. You should do it. Mm-hmm. You could have $100 billion business with just 5-year bonds. I'm not going to do it. So it's like, there's like a million flavors of ice cream that could be done. And he's just going to do stretch, right? And then you have all the different districts. So like, for example, was it on your show? He said like, he's not going to go to Japan. He's not going to go to the UK. So then you have all the different currencies, all the different markets. Like, dude, all of a sudden you could see how there could be 10,000 of these. Yeah. But really, I think if we just take the lens and we'll put a pin on this, the plug is that it's soaking up the demand for yield, which is the single largest market in the world. We're talking, 300 trillion. Yeah. 145 trillion of that is tradable securitized. So like actual trading stocks, a lot of it is not. So 145 trillion alone. In the US alone, 28 trillion of just cash and cash equivalents. So it's like, bro, you can have 10,000 companies all make $1 trillion each.
The transition we are watching in 2026 is the financialization of the Bitcoin standard. We are moving away from Bitcoin being just a coin in a digital wallet to it becoming the foundational asset for the global debt and insurance markets. Mark Moses' message is clear. The market has room for 10,000 companies to each make $1 trillion by adopting this standard. We are matching liquidity, risk, and duration in a way the world has never seen. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.